In the ever-evolving world of finance, one might wonder, what is the current state of the market, and is there potential for a capital rotation event? The answer may be found by examining historical patterns and understanding the implications of market stagnation, inflation, and capital rotation. Consider, for instance, the so-called lost decades. Between 1966 and 1981, the S&P 500 seemed to stagnate, with nominal figures barely budging. Yet, when we account for inflation, the market suffered severe losses, up to 70% in some cases. Fast forward to the turn of the century. European stocks took a staggering 25 years to recover nominally from the year 2000, all while inflation silently gnawed away at real value. These periods underscore the potential for a capital rotation event, suggesting that gold may outperform stocks in certain market conditions. Scene script. But what does the future hold for stocks? There are three potential scenarios to consider. First, we might observe sideways movement. With household equity allocations currently hovering around 40%, we could experience a period of prolonged stagnation, reminiscent of past lost decades. Alternatively, we might witness a nominal decline. There's an interesting indicator, often referred to as the blood indicator, that compares the T-bill to high-yield spread. This can signal potential crashes, suggesting a strategic shift to assets like gold, real estate, and high-dividend stocks during downturns. Finally, there's the possibility of a melt-up. In a scenario of hyperinflation, both stocks and gold could experience nominal rises as the dollar collapses. Case in point, the dollar has had its worst start in 30 years in 2025. These scenarios highlight systemic risks in our current monetary system, which relies heavily on perpetual credit expansion. As the economist Ludwig von Mises warned, such a system is destined for inevitable collapse. A potential solution could be transitioning to a non-debt-based system, possibly one backed by gold, to stave off such a crisis. In light of these insights, how should one navigate the investment landscape? Prioritize buying undervalued assets such as high-yield stocks, post-crash, and always consider inflation-adjusted returns over nominal gains. But be cautious. Official inflation metrics may not paint the whole picture. Alternative measures, like those provided by shadow government statistics, can offer a more accurate reflection of reality. To summarize, the potential for a capital rotation event, the various scenarios for stocks, the systemic risks in our monetary system, and the need for strategic investment all point towards one conclusion. We must be prepared for volatility and be willing to adopt systemic reforms to address the fragility of our monetary system. Remember, fortune favors the prepared mind, and in the world of finance, knowledge is the best preparation.